Ladies and gentlemen, thanks for tuning in. We're at the KC Research Recovery Reality Check Summit. We're talking with John Hathaway, one of the more successful fund investors, institutional investors in our precious metals field, near and dear to my heart. So, John, can you give us a quick version of what you talked about here for those who didn't make it to the conference?
Sure, yeah. I think we're at the end of a correction that resulted from the peak last summer. It was overcooked, kind of hyperventilated hysteria over the debt ceiling talks, the rating downgrade of the U.S. sovereign debt, and I think basically the stocks and the metal have been working off that boil down to what we now have as a simmer. I think we are at a position where there's not a lot of downside, and I would not be surprised by revisiting the previous highs of 1900 and maybe even new highs over 2000 this year. You know, what will do that is basically, I think, so much of the narrative has been quantitative easing. When Bernanke announced on the 29th of February that they were done with quantitative easing, and if you believe that, I've got a bridge to sell you. But for the time being, let's assume that there won't be any. I was very impressed that gold did not go to a new low. It printed somewhere below 1,600 at the end of the year, made a couple of days swoon, but it didn't go to a new low. And then when the Fed minutes came out, it also did not go to a new low. It kind of reiterated what Bernanke said. So, you know, the narrative may be changing. I'm not ruling out quantitative easing as a possibility, but there are things out there that gold might be looking at that the CNBC mentality hasn't figured out. Remember that gold rose for many years before we even heard of quantitative easing. It was in a steady uptrend. So, you know, what could those things be? What would take gold? What would be the new headlines that might take gold to higher highs? You know, to me, the biggest thing is that the Federal Reserve has purchased something like 61% of all new Treasury debt in the last year. And if they aren't going to continue that, then, you know, what's going to happen to rates?
Right.
The Chinese, who had been big supporters because they were rigging their currency, have not been generating foreign exchange to anything like the extent they were. So their participation rate in Treasury auctions has gone way down. If you look at the TIC numbers, foreign buying of Treasuries has dropped precipitously. So you have the two biggest pillars of support for keeping rates low are in question here. And let's see what happens on June 30th. You know, are rates going to, if you don't have a political buyer, either the Chinese and foreign buyers who are manipulating currencies, and the Fed because they said they aren't going to do it, you know, what are rates going to do? If you are going to get a risk-free return, inflation adjusted today, that's not politically motivated, it's got to be somewhere around 4 or 5%. On the short end of the curve. You know, every 100 basis points adds a huge amount to the budget deficit. So, you know, to me, we're in a real trap here, where it's going to be a game of chicken as to whether the Fed can really live up to what Bernanke said on the 29th.
Isn't that really the bottom line? They can't allow that interest rate to rise. With the debt out.
It seems very difficult, and the recovery, the alleged recovery that we have is you know, I'll grant that things are better than they were a year ago or 2 years ago, but you'd have to call it feeble at best, and maybe not sustainable. So that's one thing that I think could affect the gold market. The second thing, and I think it's very important too, is that inflation is rising, even though the economy is soft. The number I look at, and I know we're going to have John Williams speak at lunch, and we know, you know, he has a very good take on it. But I look at the MIT inflation index, because that's real-time pricing of billions of products. You can get to that website just by Googling MIT inflation project. And that does not include services. Most of the services I take are inflating at more than 5%. They're closer to 10%. But goods that can be measured in real time are rising at 5%. So that's also going to be a factor. That means if rates stay where they are, the Fed's just going to be that much more behind the curve. So those are two things. And the third thing is that there's $1.5 trillion of liquidity in the system that should the recovery, and I'm not a macro forecaster, but let's say the recovery does sustain itself. You've got $1.5 trillion of free reserves that could just